Dear students, hello and welcome to the first session of Class 12 Accountancy. We shall begin with the unit of Accounting for Partnership Firms, which includes 7 chapters, namely Fundamentals, Goodwill, Change in Profit Sharing Ratio among Existing Partners, Admission to a Partner, Retirement of a Partner, Death of a Partner, and Dissolution of Partnership Firm. And altogether, this unit counts for 30 marks. So, we shall now begin with the first chapter under this unit, that is, Accounting for Partnership Firms, Fundamentals. As in Class 11 you had studied how a sole proprietor prepares his books of accounts, similarly, here you would learn about how a partnership firm prepares its books of accounts. This chapter focuses upon how profits and losses are distributed among partners. So, let us learn. What is partnership? Section 4 of Indian Partnership Act 1932 defines it as partnership is the relation between persons who have agreed to share the profits of a business carried on by all or any one of them acting for all. Here, persons who have entered into a partnership are called partners. Together, they are called a partnership firm, and the name which will be given to such a firm by the partners will be known as the firm's name. Nature of partnership. Nature of partnership has 2 viewpoints. First, legal viewpoint, and second, accounting viewpoint. So let us understand what does the legal viewpoint say. Like sole proprietorship, partnership is not a separate legal entity from its owners, that is partners. It says that if the firm is not able to pay its liabilities, then private assets of partners can be utilized to pay off the liabilities of the firm. Accounting viewpoint. Partnership is a separate business entity from its partners. This means that the transactions will be recorded from the point of view of the firm and not the partners. Now, from the definition and nature of partnership, we can draw some important features or characteristics of partnership, which are: first, 2 or more persons, that is, there must be minimum 2 persons to start a partnership business, and those 2 persons must be capable of entering into a valid contract, because the Indian Contract Act 1872 says that a minor, persons of unsound mind, and persons disqualified by any law cannot enter into a valid contract. Second, maximum number of persons. According to Rule 10 of Companies Rules 2014, a partnership firm can have maximum of 50 partners. Agreement. There has to be an agreement between partners which can be either written or oral. If the agreement is in the written form, then it is known as partnership deed. Fourth, lawful business. The business carried on by the firm should be lawful. Fifth, profit sharing. The agreement between partners must be to share profits and losses of a business. Though the definition of partnership mentions about profits only, but sharing of losses is implied. It is not necessary that all partners might be sharing the losses, and also if persons have joined hands to run some charitable activity, it too would not be defined as a partnership. Sixth, business carried on by all or any one of them acting for all. The relationship among partners is that of mutual agency, That is, partners act as both agents as well as principals. Rights of partners. Every partner has the right to participate in the management of the business, be consulted about business affairs, inspect the books of accounts and have a copy of it too, share profits and losses in an agreed ratio. If a partner has advanced loan to the firm, then he has a right to receive interest on his loan at an agreed rate, or if the rate isn't mentioned in the deed, then it is to be allowed at the rate of 6% per annum. A partner can act according to his best judgment if need be, and be indemnified or reimbursed for expenses incurred by him. A partner has the right of not to allow admission of a new partner. A partner can retire from the firm after giving a proper notice. A partner can get indemnified by the firm for payments made by him on behalf of the firm. Partnership deed. As mentioned earlier, partnership comes into existence by an agreement. It can be either oral or written. The written agreement is known as partnership deed and is advisable also to avoid disputes. It is signed by all partners. It contains all these different clauses. Provisions of Indian Partnership Act 1932 applicable in the absence of partnership deed. If the partnership firm does not have the partnership deed, or it is silent, or it does not have a clause with respect to any of the following, then the provisions of Indian Partnership Act 1932 would apply, which are: in the absence of partnership deed, the partners would share profits and losses equally among themselves. No interest shall be allowed on their capitals. No interest shall be charged on the drawings made by them. Interest at the rate of 6% per annum is allowed on loan advanced by the partner to the firm. No remuneration, that is, salary or commission, is allowed to any partner. No person can be admitted as a partner unless all partners have given their consent to it. Liabilities of partners. They are subject to agreement among partners. First, if a partner carries on a business that is similar to that of the firm in competition with the firm and earns profit from it, the profit earned from such business shall be paid to the firm. Second, if a partner earns profit for himself from any transaction of the firm or from the use of firm's property or business connection, the profit so earned shall be paid to the firm. Some other important provisions of the Indian Partnership Act 1932. Section 30 says, if all the partners agree, a minor, that is, a person below the age of 18 years, may be admitted for the benefit of partnership. Section 31 says, a person may be admitted as a partner either with the consent of all the existing partners or in accordance with an agreement among the partners. Section 32 mentions, a partner may retire from the firm either with the consent of all the other partners or in accordance with an agreement among the partners. Section 69 mentions, registration of the firm is optional and not compulsory. Section 35 says, Unless otherwise agreed by the partners in the partnership deed, a firm is dissolved on the death of a partner. Practical questions. Now, let us solve some questions on the basis of the topics you have learned so far. A, B, and C are partners in a firm without a partnership deed. How will the following matters among them be resolved? First, A has contributed more capital than other partners and demands interest on capital at 10% per annum, but B and C do not agree with him. B and C are correct over here, as there is no partnership deed, so according to the provisions of Indian Partnership Act 1932, no interest on capital is payable to any partner. So, no interest on capital will be allowed to A. Second, B devotes full time in the business and demands a salary of Rs 5,000 per month, but A and C do not agree with him. A and C are correct here, as there is no partnership deed. So, according to the provisions of Indian Partnership Act 1932, no salary is payable to any partner. So, no salary will be allowed to B. Third, C demands interest on loan of Rs 50,000 given by her at the market rate of interest, that is, at the rate of 12% per annum. So here, C's loan to the firm is Rs 50,000 and he demands interest on loan at the rate of 12% per annum. As there exists no partnership deed, rate of interest on loan advanced by a partner is 6% per annum. So, C will be getting an interest of Rs 3,000, that is 50,000 into 6 upon 100 is equal to Rs 3,000. Fourth, A has withdrawn Rs 10,000 from the firm for his personal use. B and C demand that interest on drawings should be charged at the rate of 10% per annum. Here, B and C are not correct, as there exists no partnership deed. No interest on drawings is charged from the partners. So, no interest will be charged from A on his drawings. Fifth, profit before taking into account any of the above claims was Rs 50,000 at the end of the first year of business. A demands share of profit in the capital ratio. Here, A's demand is not valid, as there exists no partnership deed, so profit will be distributed equally among partners and not in the capital ratio. It will be calculated as under. The profit given to us before above claims was Rs 50,000. Now, there was one claim, that is, interest on C's loan. So that will be deducted over here. So less interest on C's loan is equal to Rs 3,000. And divisible profit now left with us is Rs 47,000. This will be distributed equally among A, B and C, that is in the ratio of 1:1:1, and each one will get the share in profit equally, that is 1/3 of Rs 47,000, the working of which has been clearly shown to you on the screen. Sixth, B wants to introduce his son D as a partner. C objects to his proposal. In the absence of partnership deed, according to the provisions of Indian Partnership Act 1932, no person can be admitted as a partner in the business until all the existing partners give their consent to it. So, B's son D cannot be admitted as C has raised an objection to it. I hope question number 1 has been well understood by all. Now, let's move on to question number 2. Bose, Sarkar and Chatterjee are partners in a firm and do not have a partnership deed. Bose introduced further capital of Rs 2 lakh on 1st October 2019, whereas Chatterjee took a loan of Rs 50,000 from the firm on 1st October 2019. Disputes have arisen among them on the following issues. First, Bose demands interest at the rate of 10% per annum on Rs 2 lakh being his extra capital. Here, in the absence of partnership deed, provisions of Indian Partnership Act 1932 will be applicable. Accordingly, no interest is allowed to partners on their capitals. So, no interest will be allowed to Bose on his extra capital. Second, Sarkar desires that his son Deep should be admitted as partner and he will give him half of his share. Bose and Chatterjee do not agree. In the absence of partnership deed, provisions of Indian Partnership Act 1932 will be applicable and accordingly no person can be admitted to the partnership until consent is given to admission of a new partner by all the existing partners. So, Sarkar's son Deep cannot be admitted as a partner as Bose and Chatterjee deny it. Third, Bose and Sarkar are of the view that Chatterjee should be charged interest on loan from the firm at the lending rate of the banks, which is 12% per annum. Please note, here the partner, that is Chatterjee, has borrowed loan from the firm. As there was no partnership deed, no rate of interest had been agreed on loan borrowed by a partner from the firm. So, no interest will be charged on loan borrowed by Chatterjee from the firm. Fourth, Sarkar has withdrawn Rs 50,000 from the firm for his personal use. Bose and Chatterjee are of the view that Sarkar should be charged interest at the rate of 10% per annum. As there is no partnership deed, provisions of Indian Partnership Act 1932 will be applicable. Accordingly, no interest on drawings is charged from any partner. So, no interest on Sarkar's drawings will be charged. I hope the second question was also interesting. Now let's move on to question number 3. Harshad and Dhiman are partners since 1st April 2019. No partnership agreement was made. They contributed Rs 4 lakh and Rs 1 lakh respectively as capitals. In addition, Harshad had given loan of Rs 1 lakh to the firm on 1st October 2019. Due to long illness, Harshad could not participate in business activities from 1st August 2019 to 30th September 2019. Profit for the year ended 31st March 2020 was Rs 1,80,000. Dispute has arisen between Harshad and Dhiman. Harshad claims, first, he should be given interest at the rate of 10% per annum on capital and loan. Here, Harshad's claim is invalid as no interest on capital is allowed in the absence of partnership deed. According to the provisions of Indian Partnership Act 1932, with respect to interest on his loan, he would be given an interest at the rate of 6% per annum. It will be calculated as under. Interest on Harshad's loan is equal to rupees 1 lakh into 6 divided by 100 into 6 divided by 12 is equal to rupees 3000. Now here, students, please note that Harshad had given loan to the firm on 1st of October 2019. So, till 31st of March 2020, the time period will be 6 months, and so it has been accordingly calculated for 6 months. Second, profit should be distributed in the ratio of capital. According to the provisions of Indian Partnership Act 1932, in the absence of partnership deed, profits are distributed equally among partners. So, Harshad's claim is invalid as profits shall be distributed in the ratio of 1:1 and not in capital ratio. Dhiman claims profits should be distributed equally. According to the provisions of Indian Partnership Act 1932, in the absence of partnership deed, profits are distributed equally among partners. Accordingly, Dhiman's claim is valid and profits will be distributed equally. So, now the profits available to us before any of the above claims are rupees 1,80,000. Now, deduct interest on Harshad's loan from it of rupees 3,000 and the net divisible profit available to us will be rupees 1,77,000. This profit will be distributed equally among Harshad and Dhiman, that is, in the ratio of 1:1. So, half of 1,77,000, that is rupees 88,500 each, would be given to both Harshad and Dhiman as their share in profits. Next, he should be allowed rupees 2,000 per month as remuneration for the period he managed the business in the absence of Harshad. In this case again, in the absence of partnership deed, provisions of Indian Partnership Act 1932 will be applicable. Accordingly, no remuneration is allowed to any partner. Therefore, Dhiman's claim is invalid and no remuneration will be payable to him. Next, interest on capital and loan should be allowed at the rate of 6% per annum. In the absence of partnership deed, provisions of Indian Partnership Act 1932 will be applicable. Accordingly, no interest on capital will be allowed to the partners, while interest on partners' loan is payable at the rate of 6% per annum. Hence, Dhiman's claim with respect to interest on capital is invalid while on loan is valid, calculation for which has been already shown. Now, students, please note that this question also demands the preparation of profit and loss appropriation account. Though you would learn it in the next session, but as the question demands, I would show that too to you, which is just like profit and loss account. If you remember, in class 11, you had done the preparation of financial statements of a sole proprietor, where you learned how to make the trading account, profit and loss account, and the balance sheet. Similarly, A partnership firm also prepares trading account, profit and loss account, profit and loss appropriation account, and then the firm's balance sheet. Now, here, please note that for the profit and loss appropriation account, we do not have any date column. It is so because it is prepared on a single date, that is for the year ended 31st March. So, in the given question, the year given to us is 2020 and it has been dated profit and loss appropriation account for the year ended 31st March 2020. Profit and loss appropriation account is always credited with the profit transferred from the profit and loss account. So here also please see that it has been credited with profit of rupees 1,80,000 from the profit and loss account. Then you also deduct here the loan interest on Harshad's loan, that is of rupees 3,000. Now it has been deducted on the credit side because interest on partner's loan is a charge against profits. It is not an appropriation of profit. Now the differences between charges and appropriations are going to be learned in the next session. So here we need to know that this is a charge against profits and so it has been deducted from rupees 1,80,000 and the balance profit, that is the divisible profit, has been brought to the outer column as rupees 1,77,000. Now, profit and loss appropriation account is debited with appropriations to partners, that is interest on their capitals, salary, commission payable to partners, or transfer to reserve if any. But in the given question, we have no such appropriations to partners. So this divisible profit 1,77,000 will be divided among the partners in the ratio. Now the ratio over here is equal, so it has been divided into 88,500 each. Now see, it is written profit transferred to partners' capital accounts, that is Harshad's capital account and Dhiman's capital account. If you remember, in your last class also, you calculated net profit from profit and loss account, which was further added to the capital in the balance sheet. Similarly, over here also, we are dividing the profit among the partners, which is further being added to their capital accounts. Finally, you are going to total up both the sides with the same amount, that is rupees 1,77,000. So, dear students, with this we come to the end of our first fruitful session of Accountancy Class 12. I hope you enjoyed learning as I enjoyed teaching. Practice well, stay indoors, stay safe and healthy. Would soon upload the next session. Till then, goodbye and happy learning and happy living. Thank you.